right, everyone, we're going to get started. I know we stand between you and cocktails, so we'll be quick, and maybe next time we'll actually have cocktails at this last session. It might work out nicely. My name is Lisa Pendergast. I am the Executive Director of the Commercial Real Estate Finance Council. I'm going to have the panel introduce themselves and then talk a little bit about CREFC, and then we'll open it up and we'll have questions. Do you want to start, Leland?
Leland Bunch, Bank of America. I run our capital market side for the real estate business.
Hi, I'm SAIRAH, BURKI, also with CREFC. I run regulatory affairs and our sustainability initiative.
Hi everyone, I'm Jason ROZES. I'm a partner at the law firm Dechert. I run our real estate lending team. Commercial real estate finance has been the core of my practice for 22 years, mostly on the loan origination side, large loans, CMBS, and balance sheet. On the subject of ESG, I hold a certificate in the science and economic impact of climate change from the Climate Reality Project. That's one of the leading nonprofit organizations dedicated to solving the climate crisis. I've written a number of white papers on the subject, and I'm part of the CREFC Sustainability Working Group with my colleagues up here. And I've spent a lot of time this year talking to my clients about green loans, green bonds, ESG, energy efficiency data collection, and all the laws that are impacting the sector. It's great to be here, and I'm excited to talk to you about a topic that I'm passionate about.
Good afternoon. My name is Lisa Biselli. I'm on the Multifamily Capital Markets Group at Fannie Mae, based out of DC. I'm also part of our green financing program. We have been in the market for, call it 10 to 11 years. We have issued over $99 billion worth of green MBS in the multifamily space. And we're very involved as a firm in the ESG movement through CREFC, as well as a few other organizations, including ICMA.
Hi, I'm Michael Reuter. I'm with the law firm Cadwalader. I focus my law practice on CMBS, commercial mortgage-backed securities, both agency, Freddie and Fannie, and private label for the likes of Leland and his kind. And from an ESG standpoint, our firm's trying to position ourselves as a leader, not just in structured finance, but in sustainable structured finance. And so we, are putting a lot of our efforts into thought leadership pieces and setting up a ESG task force.
Great. Again, Lisa Pendergast, just a little bit about the Commercial Real Estate Finance Council. We've been around for almost 30 years at this point, and it's very much focused on all aspects of commercial real estate finance. So we have the lenders and we have the debt investors, the institutional debt investors. But our lenders comprise the securitized lenders, the CMBS, the CRE CLO issuers and securitizers, and then we have the life companies, the banks, Fannie, Freddie, Ginnie, and then the slew of debt funds that arose out of the global financial crisis. All told, we have about 350 companies, about 16,000 members, individual members that comprise CREFC. I think it's important to know that CREFC and the other trade associations that have focused on commercial real estate, they're called the National Real Estate Organizations. Beginning in March of 2020, there was a significant amount of advocacy work to try to find relief for property owners, for the lenders, for tenants. And it's, in some ways, I think we were successful. We had some wins, we had some misses, and yet generally it was, I think, a positive experience, and it helped, on the margin anyway, improve the atmosphere and the environment for everyone involved in the market. To the extent that we do have a report that I just want you to be aware of, it's really a COVID relief timeline, if you will, of all the efforts that were made and those things that we did that were actually useful, beneficial, and some of the things that we weren't able to achieve, usually because of some structural issue within the loan itself or other issues that are extant in the marketplace. So if you'd go on our website, you'll see it's the COVID-19 relief effort from CREFC and the other organizations, and I think it can be very, very helpful. I just want to mention a little bit about what we've been doing on the ESG front. Our focus really is on ESG-related disclosure. It is something that I think we're focused not only in the securitization market, but whatever we do for securitization, which will be our first focus, we can then transfer to all of the other lender types out there. So what you do for a CMBS loan in terms of capturing data, you can do the same for a life company, a debt fund, a bank, or whomever. And that's really going to be the way in which we operate, is thinking from a broader perspective. I also think that in many ways, CREFC is uniquely sort of positioned to do well on this issue, because what are we doing? We're managing data. We have an investor reporting package for our CMBS and for, growingly, for our CRE CLOs. And to the extent that that report comes out monthly, has 400 data fields, and sitting myself as a research analyst at one point, trading credit bonds, those types of things, you realize that it's that level of information that provides significant transparency to the market, that provides significant liquidity, and at the end of the day, allows those bonds to trade tighter and for our mortgage rates as a result to be lower. So we're very hopeful that we can use that IRP, that investor reporting package, to co-opt sort of the data that we know we have today, add to it, and then put it out into the marketplace. A couple of other issues, and I do want to say, as it relates to Schack, we have become great partners with Schack, and I should have started off with this, in terms of, I guess about 2 years ago now, we instituted the CREFC Center for Real Estate within Schack. That has been a partnership that has been outstanding. It's allowed us to provide scholarships to Schack students. More importantly, to share what we do best on the education front. We have a class for all of our CREFC members that is held on a quarterly, on a semester basis. And there's things like events like today. So I want to really thank, I know he's here somewhere, I don't see him.
Over there.
Dean Shandon and Professor Savage for all of the work that they have put into this partnership. It's really been very rewarding, I think, for all parties concerned. So with that, I'm going to get started and start shooting questions at this really wonderful panel. Let's start off with Jason. I'm going to ask you to kind of set the table. I often hear the phrase, climate's impact on buildings and buildings' impact on climate.
Thanks, Lisa.
Talk to us about that.
It's a terrific question. I think both sides of that popular phrase that you cite originate from the same place, and that's the climate crisis that's facing the planet. So climate change is the #1 threat to the global economy. Every country, no matter location or size or wealth, will suffer economic losses from climate change. So it's common knowledge, of course, that mankind's burning fossil fuels is warming the planet at an unnatural and dangerous rate. 19 of the 20 hottest years on record have occurred since 2002. The hottest have been all the past 7. Floods and extreme rainfall occur now 4 times more often than in 1980. For every 1 degree of Celsius, the air can hold 7% more water vapor. That means you have more likelihood of extreme weather events, and because of warmer temperatures, more of that precipitation is in rain and not snow. For the past decade, California has seen 5 of its worst 10 wildfires. And even though the planet is warming, we also can see extreme cold weather for the first time earlier this year because of the polar vortex. The entire state of Texas was in a winter warning freeze. Millions of people without power, supply chains interrupted. A little bit closer to home, we have to worry about sea level rise. So the average rate of sea level rise from 2006 to 2018 has been a little less than 4 millimeters per year. If you go back to prior 30, 35 years, it was less than 2 millimeters a year. And 1/3 of the population on the planet, it's like 2.5 billion people, live near a coast. Switching gears to what's the building's impact on the climate, equally important, a little bit less obvious. People think electricity, of course, but that's actually not the first, the #1 source of greenhouse gas emissions. Is #2 at 27%. Transportation is 4th. #1 is actually manufacturing at 31%. So by that, I'm talking about concrete, cement, steel, glass, plastic, all the things used to build commercial real estate. And making these materials to build has become just as crucial to the economy as electricity 24/7. We're not going to stop building. But the good news, and I'll end on a good note, is that the industry knows how to make green buildings. whether it's LEED certification, energy efficient appliances, HVAC, seismic retrofits. Green buildings have proven to do better over time.
Fantastic. Just recently, COP26 concluded. SAIRAH, do you want to talk a little bit about what they've decided and what it means?
Sure, and I know Jason has been following it closely as well, but I think someone mentioned it earlier. It was one of those agreements where no one was particularly happy. You had some folks who walked away thinking not much was accomplished, not nearly as much was accomplished as needed to be accomplished, and others thinking, well, we did get some agreement on some issues. I think some of the highlights were an agreement to cut methane, to tackle deforestation, to reconvene next year to try to reduce country emissions because they couldn't quite get there this year. But there was some additional on the finance side, some important announcements. For example, this probably does not jump off the pages of the newspaper, but the IFRS, so the International Financial Reporting Standards Foundation, announced the creation of the ISSB, which is the International Sustainability Standards Board. It was a very welcome announcement because there's been an alphabet soup of different types of disclosure setters, standard setters as it relates to ESG. So folks are calling this a really significant development globally to have one kind of standard setting organization devoted to ESG disclosures. It'll be working in conjunction with the International Accounting Standards Board. So we'll talk about this a little bit later in terms of what CREFC is doing, but that was a positive outcome.
Jason, you want to add anything?
Oh, just real quick. So we went into the Glasgow COP26. The warming's already been 1.1 degrees Celsius above pre-industrial. The goal was to try to stop at 1.5 degrees Celsius, and so according to the best estimates climate action tracker, 1.8 degrees is sort of best case. And so to SAIRAH's point, they asked all the countries to come back next year with a new target for 2030. It's called an NDC, a nationally determined contribution, to try to ratchet down the emission standards.
Right. No, thank you. We have deployed what seems to be like an army in a sustainability initiative that has 3 subcommittees and I think well over 150 of CREFC's members that are involved. It's an important one because it has mobilized us on a number of fronts. One of the things that we did recently was to take a survey of our membership. And I have sort of almost like a confession to make. I have a counterpart in Europe. He runs CREFC Europe. And he asked me, I guess several months ago, he's like, are you going to be out here for COP26? And I have to say, I kind of said, who? What? And it made me realize that we as a country are probably a little bit further behind than other countries, at least in the discussion. And so to the extent that this sustainability initiative, if anybody here is a member of CREFC or just wants to get involved in any way, please don't hesitate to reach out to me and we can help you do that. So, SAIRAH, we did do a survey about ESG as it relates to our members, lenders, debt investors, the whole gambit. What were some of the results?
Yeah, so as Lisa mentioned, we kicked off a sustainability initiative earlier this year. And in conjunction with that, we issued a survey among our members to kind of level set and see where we should focus our initial efforts. I think one of the biggest outcomes was the fact that it sort of confirmed that our starting in this initiative actually made a lot of sense. So nearly half of the respondents reported having an ESG framework already, and nearly 40% reported having one in development. It's something that is very, very important to many of our members. Again, this is not a surprise given the focus of our trade group, but the vast majority of the respondents in terms of ESG indicated that they were primarily at that point, I should say, focused on the E of ESG, so climate risk, both impact to the buildings and buildings impact to the climate, with sort of an equal split behind environment of the social and the governance. But that being said, we have seen over the past couple of months, and everyone on this panel is part of our kind of steerco guiding committee for our overall initiative, we've been seeing a lot of interest in the social and the governance gain traction and try to, figure out how that dovetails with commercial real estate finance. And then I think just to close that out, we asked in the survey, what is the driving force behind your company's, focus on ESG? And we found, the top three really were client demand, firm values, and firm reputation, with regulation being the fourth. I think if we redo the survey next year, which I think we will, regulation will probably have crept up the bar chart there, because we're seeing a lot of focus under the Biden administration of this all-of-government approach to ESG, particularly climate change. So we're seeing, regulatory initiatives being embedded across the entire kind of financial regulatory ecosystem. So there's just a lot more focus on regulation, pending regulation, whether it's, climate stress tests or disclosures or what have you.
Fantastic, thank you. I'm going to turn to Lisa BOZZELLI from Fannie Mae. ESG investing from an institutional debt investor perspective has certainly increased over the last 12, 24 months, and the focus of the discussion has increased. And yet, when you think about Fannie Mae, you guys have been at this for quite some time. And it's almost in some ways, except for those investing in yourselves, it's not all that well known that that's true. And so I wanted to ask you about the program, how it gets started, what does it look like today? And more importantly, I'm very interested in who's buying these bonds.
Sure. So as Lisa mentioned, we started our program in 2010, and really it came about as trying to figure out how to make energy and water consumption reduction or improvements in our properties. As you may know, Fannie Mae is a secondary market participant. We're on the multifamily side, so we're talking apartment buildings. We have an affordable housing mandate, so most of our apartment buildings are not that pretty. They're maybe 40 years old on average, and so we really knew that there was going to be a challenge to operating, and from a risk perspective, continuing to operate these properties. So what we did was did a lot of trial and error, because no one was watching, which was great, and also found out that, to Lisa's earlier point about data, there wasn't any data. There was no point to say, hey, this is your starting point, you make the improvements, this is your ending point. So what we did was we did a big benchmarking study with the EPA's Energy Star portfolio manager. And then we were able to, they defined a 1 to 100 score for the multifamily asset class, which didn't exist at the time. And this at least allowed us, because we are a national organization, we have to apply to all different markets, to be able to compare each of these market assets to one another. So a lot of trial and error, a lot of partnerships over the years, and we ended up with two major products. So one is green building certification, which most folks are very familiar with. LEED certified is what most people think about, but we have over 40 different certifications that we recognize, and there are far more than that in the market. We just make sure that they coincide with our priority of energy and water consumption reduction. That is also used to be a much smaller part of our business because it was largely focused on new construction, which is not a large portion of our portfolio. So our bigger focus at the time was a product called Green Rewards, which is an in-place energy and water consumption reduction. So we incentivize borrowers to make energy and water improvements. They have a goal that they have to make within a certain amount of timeline. Now it's 30% energy and water consumption reduction improvement over 12 months, with 15% of that focused on energy. That's changed over the time. It's gotten more conservative as time has gone by, and we've been able to kind of test the market and see what the market would bear. Because at the same time, you really do, as a borrower, as you know, at the end of the day, it has to make economic sense for you. So that's how we have basically got our start. We've grown a lot over the years. Lisa asked a little bit about what investors are participating. Our bonds don't have anything different in their credit than our regular bonds, our regular MBS. So in the very beginning, nobody really cared that they were green, I'll be perfectly honest. It was a very small group of investors who were focused on socially responsible investment that would participate in our deals. Everybody else just bought it because it was an agency MBS. And that has changed over time, especially the last, call it 18 to 24 months. We're seeing a lot more participation from bigger groups. And so it's got a lot more diverse, and I would say now it's basically a cross-representation of our existing agency CMBS investors.
Are there funds that are specifically ESG focused that are involved, and is that a small percent relative to the
I would
more
say
macro?
there are smaller orders, right? Because even if you're a big fund manager, you maybe only have one fund or two funds that are focused either on housing or on environment. So yeah, the orders tend to be smaller when we're looking at our bigger GEMS deal books. But they are, as we say, stickier, like they'll stick around because they really don't have as many options in the market. But again, that itself has also changed dramatically over the past year. B of A, Leland's organization, their DISC puts out an ESG run in the capital markets, which was the first time we had seen that in our market. So now, instead of somebody just showing you all agency paper, they're showing you specifically ESG-related paper from labeled programs. That's a huge step forward for folks who are looking to see. It also allows me to look and see how not cheap my bonds are, how I might get pushback on a deal. But no, it's been a lot of steps in the past 18 months.
Yeah, I mean, that's a huge step for liquidity in this market, and it does encourage more of you doing more of the same.
Exactly, and gets the word out, right, on
Sure.
different
Yeah.
assets.
What's out there, yeah, sure. I'm going to move to, well, actually, a couple more questions for you, Lisa, not to pick on you. But from a social perspective, how do you manage this when you're Fannie Mae, you have sort of a mandate as it is to support the multifamily market, and yet there's also a social aspect on the affordable side. And if you think about the way in which you're structured with FHFA, you have mandates also to very much focus there. So how do you make the differential in your balance sheet on what you're doing on the affordable side and what you're doing sort of that's just straight Fannie Mae multifamily business?
Certainly. So I think if anyone's new to the market, you should look into the International Capital Markets Association Green Bond Principles and Social Bond Principles if you're not familiar. That's really the most basic guideline to how you can set up a program, a labeled bond program. And I think one of the big differences, folks ask this all the time, you're already doing affordable, what does social add to it? I think the biggest thing is bridging that gap between what investors want and what borrowers have or are willing to give. So again, it comes back to data, right? If you're looking for a specific investment and you have hurdles, this Green Bond Principles and Social Bond Principles, right, they ask you need to report impact reporting, right? So you may have a program or a building that has an education program for its tenants. If you don't have any data about that education program, you have no way to quantify it, right? It goes from charity to impact. It's two different things. So I really think that the social bond market requires that kind of rigor and diligence. And I think that is what goes around. Not everything that we do that is affordable is going to fit into our social bond market. And I think that drawing that line in that box, it, again, makes it easier to communicate to investors and hopefully increase the demand that comes just for those specific assets.
Great, thank you. I'm going to move on and pick on Mike for a little while here. Mike, you were involved in the One Vanderbilt Green CMBS transaction. Can you first of all, the $3 billion transaction size should stop you a little bit in your tracks. It reminds me a little of 2007 where 3, 4, 5 billion was
Hopefully
kind of...
not. That didn't end so well, by the way.
I know. Sorry, we'll stop at 3. But I guess the questions I would have was, how did this deal come together? What were some of the challenges in terms of bringing it to market and making sure that the sort of the ESG disclosures that you need to make when you want to label something like that work?
Yeah, absolutely, Lisa. And yeah, it was a very difficult deal, a large deal, high profile. It definitely, I would say, took a couple years off my lifespan. It was, but it was a tremendous success for the client. And I watched Mark Holliday's presentation earlier today, and it was, I was, loved the PowerPoint scene about the property, and it's a tremendous property, and it adds a lot to the New York skyline. So it's definitely the deal I'm most proud to have worked on in my career so far. It was a takeout of a syndicated construction loan made back in 2016. SL Green wanted to put in place fixed rate permanent financing and take advantage of the very low interest rates. And they did succeed with the help of the lending group, which was led by Wells Fargo, and a big contribution from Goldman. And Leland's team was involved in the syndicate. the big challenge with that deal, you know, ESG notwithstanding, the big challenge was with the deal that size was, you know, how can the market digest a $3 billion deal, CMBS deal? You know, it's like, you know, Thanksgiving's coming up. Is the market going to finish the whole turkey on Thanksgiving dinner, or is there going to be leftovers that are going to have to be put into conduit deals over the next weeks and months, like the MGM Grand deal that's been you know, over the last year. So look, ultimately, it was a great success and got a lot of favorable press. And you know, ESG, from an ESG standpoint, it was one factor. You know, it wasn't the reason the deal got done, but it was an important factor in the market interest. And I think that the clients got some very favorable interest from ESG accounts. But you know, you know, it was also the deal that kind of kicked off. It fired the starting gun for competition among private label CMBS lenders to compete for green loans on green buildings. One Vanderbilt was LEED Platinum certified, but you know, I have had conversations with the second-party opinion providers, and they tell me LEED Platinum is not essential to them giving a favorable opinion on the deal. LEED Gold can suffice, even LEED Silver can suffice. So, you know, since then, there have been other similar green bond deals in the private label and moving on into social as well.
So I'm going to cue Leland on this. Just talk about B of A's, you know, efforts in the ESG side, and then the JAX transaction that you issued, I think, in August.
Sure. I mean, without giving a commercial, I mean, the firm's commitment is $1 trillion-ish plus into the sector across everything globally. And I'll touch on a couple points, one of which is the U.S. versus Europe, which we've kind of talked about. And unfortunately, I don't have my notes in front of me because I thought we had a table in there. But we've run a lot of investor surveys, mainly on the corporate side. And if you look at kind of generic U.S. investors, ESG, 71% are kind of like interesting. And that's kind of, you know, and then it goes down from must have. When you go to Europe, it's kind of the high 30% that needs to be. And that's an evolution that'll eventually get here. But, you know, when the whole market started to kind of be talked about, the first inbounds we had were almost exclusively European fund managers who had U.S. outposts who wanted to try to bring across the technology into the U.S., which gets into one of the things we keep kind of talking about, which is disclosure. And to Lisa's point, you have 40 different programs of kind of standardization. And I think where we've come in the last couple of years, and from a personal standpoint, to kind of go back, I got involved in this when we refinanced our headquarters, One Bryant Park, which is down the road that way, which was the first LEED Platinum building built in North America. We built it 12 years ago in a JV with Durst. And there was nothing we could do. We had this incredible building that not only does it save energy, we actually put energy back into the grid, and there was no concept to get something in the market or get value for it. And especially when you have, getting back to One Jackson Park as an example, when you have a borrower who has a long-term commitment to ESG, the environment, and you see that very prevalent in New York City families, the New York City focused public companies. I think Mr. Silverstein was there early, SL Green. You know, this transaction was for Tishman, another multi-generation Durst, third generation family. They don't look for 5 and 10 years out. They literally are looking for 20, 30, 50 years out. And the green initiative fits really well, especially when they're building, because they're not looking at the payback ratio of a short term. They're fine being spread over 30, 40 years. And the efficiency they get actually is a positive NPV. The one in LIC was interesting because we followed that on the back of One Vanderbilt, but it was the first one that wasn't done in Manhattan. And there was a kind of a community impact to that. I mean, everybody knows Long Island City, that's far from the hinterlands these days, but it's still not Times Square, it's still not Midtown, you know, Hudson Yards, and you know, 200 West and Luxembourg. So looking at other ways real estate can affect away from just sustainability, energy efficiency, there is some impact that you can kind of do that. And the tenants in that building, it's a corporate headquarters for a large company, they were very motivated to kind of be out there and kind of bring jobs in and so forth and so on. Yeah, and it's something that we're trying to evolve to. of trying to get that message out. And I'm sure one of your questions, like Lisa, so what do investors pay for it? Well, that's the hard part. That's the work that goes into it, whether it's what Jason and Michael do on their side, what we have to do to convince our borrowers. You really have to have, you know, the borrower and the lender willing to do this just because it's the right thing. And it's kind of the concept that if you build it, eventually they'll come, and eventually there will be value. So you put the building blocks in now, and down the road, hopefully that will pay fruition to the people who come after. So a lot of these folks, you know, are kind of the trailblazers of trying to get something out there that is high profile, that's sustainable, that's repeatable. You know, what we try to do in our market is come up with something that's a blueprint for other people to follow. Because in our own self-interest, in our borrower's self-interest, the more the blueprint is out there, the more liquid things are, and that's going to result in lower pricing. The traders are going to like it better because it's more transparent and so forth. So that's kind of where we are. When that's going to come in our markets, I don't know. Unfortunately, the fund managers and a lot of the investors, and I think you'll see this led by the insurance companies, which there's probably a few here, who most of them now are scorecarding almost every investment they do. But the fund managers will probably be the big drivers of that. But unfortunately, right now, you know, they're benchmarks against things that don't necessarily have a green aspect to it, and they can't afford to miss a benchmark because then they're going to get the money taken away. So,
I mean, it's safe to say that as you start to see more of these buildings and therefore more of these transactions, I almost think that there's a fund flow that doesn't exist today because there's not the product necessarily to fill it. It's a chicken and the egg kind of discussion, right? Yep. So at some point, though, you will have critical mass in terms of outstanding bonds and transactions, and you can look at. And I think at that point, I'm hoping you'd see some sense of what you're all calling a greenium or a premium for buying, you know, on your pricing, right?
You are seeing, and to one of Lisa's points on kind of the third parties, I mean, everyone knows LEAD. I mean, that's been around for a gazillion years. It's published, it's transparent. Our LSE was actually LEAD Silver, which, you know, more than qualifies, you know, depending on how you build it. I mean, there's water and energy and a lot of different things. You know, I'm not advocating for that to be the standard, but that seems to be the one that people have grasped on. It's the easiest to understand. On One Vanderbilt and on Long Island City, we use a company called Sustainalytics, which has been around for a long time. They are a independent third party, kind of environmental company. I would say, you can tell Jason's passionate when he started. These guys and women, oh my God, they take it to another level. Like, okay, I trust you. You know, but when you have somebody who is, and they are global, when they're that renowned what they do, they're that good at what they do, they're that detailed and that focused, that helps a lot.
Yeah. So, you know, with the Sustainalytics rated One Vanderbilt deal as well, and my experience was that they're expert at what they do. There was a little bit of, you know, in terms of getting deals done, there was a learning curve for them, and there was a learning curve for the investment bankers. And finding a way to bridge the gap between them was a place where the lawyers added a little value just by being a little bit fluent in what both of them were trying to say. You know, the Sustainalytics of the world, they say that they're structure agnostic, and they don't really care about all the details of, you know, complicated transaction structures. And I think that I found that was mostly true. At the end of the day, you're financing a green building, and that's what they really cared about.
Well, and it might help for folks who aren't familiar, the whole second party opinion provider market, when you set up a labeled bond program or you do a labeled transaction, this entity is supposed to come in and say, you know, do you abide by the traditionally accepted methodologies currently in place for a legitimate green labeled program? It doesn't necessarily say whether it's green enough, and I think that's, I'm sure, going to be a question from the audience. It always is. So the idea of what is green enough really is, we do find it varies from investor to investor. And now in the past 18 to 24 months, almost every investor we know has established their own checklist, as LELAND mentioned, and they are really looking for what meets their requirements. But I do think, to the earlier point about the diversity of investment options, the US has not had the regulation that Europe has had. And in that absence of regulation, it has been business pull-through, right? And we can all remember BlackRock's letters to investors or to shareholders. I think those are the things that have pushed it in the US, and I think we're coming to a point at which it's still not going to be enough for carbon reduction targets. And at some point, you know, the SEC has had a request for input. We've had our own regulator. FHFA has also had a request for climate-related disclosure input. So I think the writing's on the wall and it's coming to all of us, but then I think you'll hopefully see a greater diversity of products out there. So you had the alternative debt panel before that, right? If those folks are if we're getting more high-yield bond offerings that are backing green programs, then you're getting more investor participation, again, more market supporting the improvements.
Right.
And just one point, it's interesting because, this is a capital markets conference, is that we keep talking about new issue, premium, use of proceeds and so forth. In the corporate market, in the high yield market, and certainly in Europe, they do step down coupons. So it's going forward what you do if you check off various things, like I did X, Y, here's the 10 things that I can do, and as you check them off, your coupon goes down.
But just to be clear, right, those are sustainability-linked bonds, right? And the reason we had to have those is because the issuers were energy companies that were dirty as the day is long by traditional green bond standards, right? So they couldn't fulfill a use of proceeds requirement because it doesn't pass the look-through test. So I think that's the challenge. Like, we have a program but people still wrote to us and were like, well, what's your ESG strategy as a company? It's not good enough that your actual asset is green. It's now the issuer has to be.
Yeah. The corporate side is nuanced because we won't get into this, but if you looked at some of the corporate issuers who issue green bonds, it's just the nature of their business on how they actually operate. It has nothing to do with actually being green. Which gets back to the whole standardization type of thing, which is frustrating for everybody.
I'm going to move for a sec to social and ask Jason to talk a little bit about what you're seeing, what makes up sort of this social part of bond investing and lending.
Sure. So I came to ESG certainly on the climate side, but the S in the social is super important. And when you think about climate change, there's actually an environmental justice piece to that. But on the social bond front, it's very exciting. Just this year, there have been 2 issuances of non-GSE private label social bond issuances. And they were both under the heading of affordable housing. It happened literally within the last 60 days, which is super exciting. It had never really been done before. One was here in Manhattan. It was like 30 buildings, 3,000 units. Another was in Florida, I think about 12, 15 buildings. Again, all affordable housing, and the measure they use is AMI, and a percentage of AMI for income. And the way it hangs together is, as Lisa was saying, it's the social bond principles. That's a voluntary framework that's put together by this group ICMA, and it literally has these 4 prongs that you need to meet. You get the Sustainalytics opinion, and it's in the market, and it's labeled as social. And again, to Leland's point about the momentum of the market, these are the first 2. In addition to Lisa's program, now you have private label, Wall Street issuing social bonds for affordable housing. That's just one prong. There could be workforce housing, there could be education, utilities, clean water, all different prongs or criteria that can be used to issue social. So it's very exciting, and I think more of this momentum that we're seeing with issuance of bonds, not just green, but now social as well.
It's interesting when you talk about that, be it social, green. We have had conversations. At some point, this conversation is going to go well beyond us. It's going to go from a legislative and regulatory perspective. I think you'll see a lot more to that effect. And so recently, SAIRAH and I and the folks at CREFC have had several conversations with the SEC commissioners who are looking to us and others to develop sort of reporting transparency regimes on the ESG issues. And our view is that we would rather be ahead of this, chatting with them, explaining what we're looking to do, rather than it coming from them to us. Happy to work together once we have sort of something on paper that we can move forward with. And it's not like there isn't data. There's a sufficient amount of data today, but we really need to have it sort of molded to what folks are looking for, especially if you have, say, an ESG fund. So what are you looking for? So it's a good conversation between we, the regulators at the SEC, and eventually, as I said, others, but also our investors, our lenders, and of course, the borrowing community, the property owners. What is it that we can deliver? And so I'm very keen on trying to get ahead of this, and again, we being the drivers of that discussion as opposed to the other direction. Again, one of the other things I did want to ask was when you think about Sustainalytics, and what they do. How does that feed into the transparency and the disclosures that we want to see, that your investors want to see, and rating agencies? And what is the role of the rating agency? Between Sustainalytics and the rating agencies, two different things,
Yeah.
but sort of oversight of these transactions.
I mean, interesting enough, not to pick on our lawyers and so forth, but when people give opinions on things, they kind of want to be given and hidden away. The Sustainalytics guys almost insist on publication of their work product. They have a bigger issue if it's under a data room with a confi on it that not everybody can get to. They want it out there for everybody to see, complete transparency and so forth. So in that sense, it's incredibly helpful because it's rare to have somebody who wants their work product out there to be scrutinized and understood, which again, from a long-term standpoint, is very good. The rating agents on the other side, I think bigger picture, that they all score transactions now, and I can't go through one by one. I think Fitch is the only one that actually has a % credit into the ratings on a 0 to 5% scale. And I think I had read, again, this is from our research, that it was like a 36 basis point impact, so which is, that's a rounding error, right? Cap rates move in 25 basis point increments. We all know that. That's a fact. So it's not, they're thinking about it, but this kind of goes down a rabbit hole. For them to kind of get involved now puts another opinion out there. Do they really want to be doing that? Are they experts in it? So having, they're obviously heavily regulated, the FCCs and NRSRO, having a Sustainalytics or somebody else out there who's operating as an independent third party within the frameworks seems to be the better way to go.
Right.
What I've always been nervous about is just having some massive fragmentation, because it's kind of historically been fragmented, where you have upstarts deciding, I can give an opinion, we can go start our own firm, we can give an opinion.
Right.
And then it's not going to carry any water, and then that's going to be the problem. So far, because it's a limited market, it seems to be kind of coalescing around, a couple kind of core things, which is helpful.
And I think that's a really important point, and that's something the SEC might ask in their proposal. It's certainly something that the folks have been talking about. Well, are they going to start regulating like the Sustainalytics of the world as a way to try to enforce some of their philosophy? So that'll be interesting.
Can that be positive? Could you use Sustainalytics to develop further sort of data fields and definitions and protocols that you could then kind of grow across platforms? There is that possibility that you could use it for good.
And I think all accounting firms are doing the same thing, right? If you talk to any of the accounting firms, they are all looking at this from a data perspective, and everyone is marketing right now. It's overwhelming, and then when you add on climate and climate data, it's another whole group of people that are out there. So there are a lot of great minds working on it, but to your point, we do have to circle up around a single or few carbon accounting methodologies as a group if we're ever going to get to one point.
And by the way, Sustainalytics is not the only second-party opinion provider. There are
We use Cicero for green.
Yeah.
there are more of them than there are credit rating agencies you can choose from. So you're just using that as an example.
So let me ask one more question, and then we'll open it up to the audience. But Local Law 97, does that law, as well as potentially it spreading elsewhere, right, lead to more green issuances over time? Could that be the trigger? Unfortunate, it's not exactly, it's a little clunky and expensive and all, but does that trigger the issuance of these retrofits to buildings that are required in order to not be fined? Anybody have thoughts there? I was just trying to put things together on that.
The lawyers definitely have
Jason,
thoughts.
you want to give it? I'm not sure everybody knows what it is. You
The
want to give
lawyers.
60 seconds.
You want to take?
Michael?
Yeah,
60 seconds?
well, yes, I think yes. Local Law 97 you may know, it places carbon caps on most buildings in New York City over 25,000 square feet. And these caps start in 2024. And as I understand it, many buildings will not meet the targets in 2024 or as they grow more stringent over the years, which means the owners of those buildings will face fines under Local Law 97 unless they spend money to retrofit their properties with energy improvements. Also for lenders, a couple things. Number one, it's going to be important for lenders lending in New York City past 2024 to incorporate some kind of energy assessment or audit into your property condition assessments. I have had conversations with AEI and GRS Group, both of which are offering these services as sort of an add-on to their standard PCA report. Secondly, if you're a lender lending in New York after 2024, you know, you should probably be asking your borrower, what is your exposure under Local Law 97? Has it been factored into your financial projections, either the fine or the capital expenditures? But I think Jason, there are some creative opportunities to deal with this.
Yeah, thank you, Mike. Yeah, so one of the ways that property owners in New York City can try to meet these standards is through CPACE, which is Commercial Property Assessed Clean Energy. It's a low-cost, long-term financing vehicle, so it's a tool. It's instituted at the state level. It's like 37 states and DC, and the regulations have been put in place for over 20 states. And New York City just released and opened their program earlier this year, and there have been 2 deals that have already happened and closed. They're in the press. There's at least 10 more in the market that are on the way. And so it's a cheap, low-cost financing where, you know, it really drives value for owners, for lenders, and for municipalities, right? So for the owners, it increases cash flow, it makes more resilient buildings. It has to be a green project the CPACE needs to finance. So whether that's HVAC or e-glazing or any type of energy efficiency improvement. For the lenders, obviously, it's increasing cash flow to the borrowers. And then for municipalities, obviously, it's improving the building stock, increasing property values. And so it is a financing tool that's out there, that's being used, and, you know, I think more to come in CPACE, certainly in New York City.
Great, thank you. We only have about 3 minutes left. If anybody has any final things they want to say. Otherwise, questions from the audience, and then cocktails. Anybody?
Thank you. Chelsea McEwen from Scotiabank. Just a quick question. From your perspective, how do carbon offset credits play into the whole transition and ESG?
Anybody?
Can't take that.
Sure. Thank you.
You're it.
So Local Law 97, the offset program is not that great. It's really a cap. And so the cap and trade that you have in like Japan, we don't have yet here in New York City. At COP26, one of the things that came out was a country-to-country carbon offset program where countries can trade credits to help meet their emission standards. And so there were some new guidelines put in place for that. 5% of the sale of the offset price goes towards helping underdeveloped countries. 2% of the credits are actually erased so that countries can't overly rely on the credits to reduce their emissions. And then lastly, what I thought was great is there's a double counting standard now put in place. There's a who counts it, so it's not just the selling country and the buying country. So actually the country that has the credit, if they decide to sell, they actually add 1 unit, and the company or the country that's purchasing gets to deduct 1 unit. So cap and trade, carbon offset, that's definitely a tool that's being used around the world. Not so much here, but I think to the points being made, more of that is to come, and that's definitely, I think, an incentive that the government can put out to have finance, to have the private sector pull this forward.
And Jason, currently, Local Law 97 compliance, you're not going to be able to use carbon caps to pass that, to comply with it, right?
That's right.
Unfortunate. Okay.
Not yet. We'll see.
Yeah.
There was
That would
one
be
more
nice.
question. I saw
Another
a hand
question?
right there. So,
Are you talking local 97 specifically? Oh, it will be. I mean, again, Yeah, I mean, whoever's taking notes on this, you know, I'm going to comment on this if you quote on this. Well, that's the New York City Council when they passed it 32-1. I mean, you have to go ask them. I mean, from a commercial real estate lender talking to our large clients who have built world-class buildings, it'll be very difficult to meet the standards because they've already exceeded the standards. And if you're a 24/7 building catering to, you know, a global financial institution who has to be open 24/7, it'll be a tax. And the next time the rents roll, they're going to pass it through. That's, yeah. Well, now you're into the, now you're into the precursor to
There's
that.
a social component, right? Just transition, everyone's heard, right? The just transition concept aligned with climate, the idea of climate transition. I think it's certainly something that everyone is very focused on. I agree, the pass-through isn't 100% there. For us, obviously, we incentivize the borrower to make the green improvements, again, separate from Local Law 97, just with our program. But again, we're not seeing that benefit necessarily in a greenium. We're not paying for it from our financing. And there's going to be a limit to it, right? Because it has to make sense for us to do it. So yeah, I agree with you. I think there are other levers to pull that nobody here is capable of pulling, to be frank.
Okay, any last questions? Yep.
I guess that gets me back to, you mentioned the regulatory environment, and it seems from a layman's perspective that the regulatory environment is way more powerful than anything we're kind of doing, which I hate to say it, I call it the ivory tower and you know, in the Manhattans of the world. But where the rubber meets the road for this issue is in the everyday owner, as Rob has pointed out here. It's the ownership of these buildings who are disincentivized to do what they need to do until the ivory tower forces them to do what they need to do. But at the end of the day, I guess my question is, how does this, what's the impact of what you guys are doing versus what a regulatory environment or change at the regulatory level could do? Because it seems that we're just scratching the surface, and it takes legislative, you know, on a local level to really move the needle here on this and force real estate owners to do what they don't want to do because they have to do it. You know, it's 97 at a national level. Is that, am I missing something, or is that the issue?
Well, I think it's a couple of things. I think from a legislative perspective, it's going to continue to be localized. You have different cities that are implementing like Local Law 97 type legislation. In the current environment, we're not going to see anything from like a federal level in terms of legislation. It could pass the House. There's no way it would pass the Senate. At this point or in the foreseeable future. I think backing away a little bit just from like a direct impact to landlords, you're going to see a lot more on the regulatory space, and that's going to be much more indirect. It's going to be much more like, we were talking about the SEC disclosure requirements, any kind of implications from that will percolate through the system. You're going to see like climate stress scenarios and stress testing in the banks, so the lenders are going to start being more focused on it. But it will be much, much more indirect. And again, from like a law perspective, it's going to be very local.
I think we're going to end it there. I think we can have all of these conversations out in the reception, and I appreciate your spending time with us this afternoon. Thank you, Sam.